Okay, folks, this is for the people that was in the Discord asking about how to use the Fib levels and what are they. Okay, so the Fib levels is like it's used for like retracements and stuff when you're trading in conjunction with indicators maybe or price action or whatever you want to use to trade it. It just to give you more confluence on taking a trade. Okay, so first off, imagine this being a leg, as as we would call it, which would be from this high to this low, right? Okay, so we go and get the field retracement, right? We looking to sell this whatever asset that it would be. So we would take the field level and we would put it from the high to the low, right? Okay, so anything but below the 50% is what we would call discounted pricing. Anything above this 50% here, we would call premium zones, right? So we don't want to sell down here in discounted zones. We would want to buy, right? We want to buy it back up to get in premium zones, even though we know we looking to sell, we can catch some scalps back up, but that's for another video. Um, we looking for price to get back around the golden zone, which would be here, right? We want price to come on up, keep going up, come on up to the golden zone, give us something right up in here, come back up about up in here, turn around, break that low, come back and mitigate it, and come on down. Right? I'm gonna pull this over a little bit so we can have it all in here. All right, get this centered. Okay, so pretty much in trading, you just looking for price to be in what you would call the golden zone, right? It's the most critical level for strong reversals. And to go even farther, you know, price sometimes pass by the golden zone and go for even deeper retracement, which would be a stronger bounce in between, the 70 and the 80%. So imagine it going, you know, up around up in here and coming back down. This is the schematic that I would look for. I would look for price to go up. This low, what put in this high, gets broken. When that low get broken, I'm looking for a pullback from this leg, from this leg here, this to this high to this low, because we already in the point of interest up here. We're at premium pricing, so now we can sell. We're not looking for buys here. We're not looking for buys because this leg, according to whatever is over here, the left, we done broke structure over here. We would be done broke structure. So say that this was the low, right? We would be done broke structure here. So if we broke structure here, if we broke structure here, that would mean that this high is strong, right? That would mean this high is strong. So we would be waiting for price to pull back into premium levels so we can sell it down, right? That's the order of the market algorithm, or where we have a high, a low, a higher low, a lower low. It'll keep going. It'll keep going like that until it doesn't, until we get a realignment and price wants to start moving back up and take this high out. But if we get a schematic here, which is actually this right here, this is a Wyckoff schematic here. Let me get me something. This little area here. This is what I want to see happen most of the time when I'm looking for a trade on a lower time frames. I'm looking for the low that put in the high to be broken, and then I'm looking for a mitigation of at least, if I come and pull my fib on it, right? I put my fib on it. Let me go right here. get my fib, and say that this was a candle high and this was a candle low. So I'm coming here and I pull it out, and we about, you know, we just a little bit over the 60. You put it about right here. That is the come on, page, come back over here. Let me try to get this page back over. All right, there we go. It's kind of okay. This is the schematic that I would be looking for. I would wait till price get back in that zone again, just like it did on a larger scale. It does it on the smaller scale, and then it falls down and take out this low, because this low was weak because it failed to make a higher high, which is here. If this low was strong, it would have made a high, and then we would go from, if it would have made a high from here, if it would have made a high, say that it just kept going up and did this, okay? If it would have kept going up, that means we would be bullish. So the thing I would do, if we were bullish like that, let me delete this, get all this out the way. If we were bullish, then say we broke that high, what I would do is I would get the fib out. I get the fib out, and I would go from this low to this new high. And I would wait to price get into discounted levels, which would be down here. It'll get into discounted levels now because we're going from low to high. This green and everything right here, this right here, I mean, well, above the 50%, that would be this discounted area, well, premium area. So we wanted to get down here into this discounted area here, because we're starting with the low, and take it all the way back up. So what we would want to see, this being the high. So let me just move this here, make it easy. Move this here. Imagine that being all high, and price done got up to the high. Price is at the high, so we want price to come back down. Do something like this. Come down, just keep coming. Get to all 61.8 and break this high that put in this low on a lower time frame. Come here, mitigate the demand zone that it would leave behind here, and go back up. This is more advanced trading. So imagine this right here being broken. That is what, we call a change of character in the market, right? That's letting us know that there's a shift going on. So we go down to the lower time frames and try to catch that shift. We want to catch that shift that's on the lower time frame. So we go down and we try to find where that shift is happening. So, like I say, it could be a demand zone left here. It could be a demand zone left right here, or a fair value gap or whatever. And price mitigates it and takes off. Our price could even, fall deeper into the leg, either or. The way you trade is the way that you would backtest the pair that you are trading. So if you go and backtest, say, AU or whatever, and you see that AU reacts really good off of the 61.8, that's where you take your trades from. If it acts better off of the 70%, you take your trades from there. Go back and backtest at least 6 months worth of data and record it. Write it down. See where it works. See what session it works on. See what time it works. And that's how you trade it in a live market. That's all I got for now. Don't forget to like, comment, and share. And subscribe. Thanks.